So, thanks very much for having me here. My name's Tom Blomfield. I'm, as you mentioned, the co-founder of GoCardless. We are an online direct debit provider, so we make it really, really simple for any kind of business to accept payments from their consumers or other businesses, actually. And what I want to talk about today, so I think over the last 10, started really with PayPal 15 years ago, a lot of the innovation on the internet has been focused around consumer payments, particularly around credit card payments or debit card payments. So you've got great companies like PayPal from 10 years ago, like Stripe, SagePay, Square, doing really, really interesting things. So now you can walk into any Starbucks and use one of the cool Square machines, or similarly in Europe with iZettle. So the last 10 years or so, there has been this huge innovation. So in B2C payments, money really is borderless, data-driven, and disruptive. By contrast, business-to-business payments have been stuck in quagmire for about the last 30 years. Nothing's really changed. So GoCardless, sort of 60 or 70% of our business is actually focused on B2B invoice payments, recurring payments for stuff like, so you go into a Starbucks and you buy your coffee, but that Starbucks is probably a franchise, and it's buying its coffee beans from a supplier up the road, it's buying its cleaning products, it's paying its workers, and all these payments are going on kind of in the background that people aren't talking about and that startups aren't sort of innovating around. And there's a huge potential for transformation there. So by way of overview, there are something like 350 billion non-cash payments every year, and that's a big number. B2B constitutes around 10% by number, but about 60% of the value is between businesses paying other businesses. That means there are fewer larger payments. Additionally, if you look at all the payments companies and banks, around 80 to 90% of the profits are in business-to-business payments. Because you have this competition across consumer payments, it's really squeezed the margins down. In B2B payments, that's not happened yet. So we're going to dive into the anatomy of a B2B purchase. It's, it's pretty scary. So talking, PayPal, you drop a pin and you walk into your Jumbo Juice or whatever and you pick up your juice, and that's the payment. It's really simple, right? Or in Square, in a Starbucks, you swipe your card. In a B2B transaction, that's not the case. So you have ridiculous processes which involve generating purchase orders. There'd be an invoicing function. You'd probably send a paper invoice out. Accounts payable receive this and check that the amount's right. They might send you a check back. I think something like 80% of B2B payments in the US last year were made by check. You've then got an accounts receivable sort of function. These poor souls have to take the inbound payments and reconcile them with invoices. And often they're working off bank statements to invoices. So every month they have thousands and thousands of transactions with some garbled reference number that people have manually inputted, and they're trying to match it against invoices. And you can see now why sort of 80 or 90% of the profit is still kind of constrained in this area. Then if you're doing a cross-border payment, you've got £10, £15 fee. You've got the FX margin that they're putting. Then on top of that, you have partial payment, you have credit terms, you might have delinquent payers, you might have bad debt. So the whole thing is sort of stuck in the mud. When you look at something like Square versus the systems that people are using in B2B payments, you can kind of start to see how innovation has been lacking. People like Sage, who FTSE 100 company, something like 750,000 businesses are using Sage Line 50, which has been around, 15 years. You have to go on week-long training courses to even work out how to deal with this thing, compared to take your phone out and swipe your card. So if Money 2.0 is borderless, data-driven, and disruptive, then Money 1.0, especially in the business-to-business world, is full of arbitrary borders and barriers, both sort of geographical barriers and just system barriers. Luckily, if there's any data whatsoever, actually passing data through the invoicing function, through to the banks, back to reconciliation, almost never happens. It's also in dire need of transformation. So the future is borderless, data-driven, and disruptive. I'm going to spend a few minutes talking about what that means in the context of business-to-business payments. So borderless, for me, is both geographical and about removing obstacles to payment. So PayPal came around, and it was, I think, basically 15 years ago. And it started out Well, it started out beaming money between Palm Pilots because Max Levchin's a massive crypto nerd. But when they realized there wasn't a huge market there, actually, it was about enabling people to pay online. So you had eBay, this huge growing marketplace, but the biggest problem was actually transferring money to another person. You'd bought a pair of trainers or you'd bought some computer parts, whatever it was. Actually transferring money to another person to pay for that on the internet was a very, very difficult problem. So PayPal came around 15 years ago, really innovating around that sole problem. How do you as a consumer transfer money to another consumer? It does sound crazy that just a simple act of transferring money to someone else could have been so difficult. But that's a reality in business to business. So B2C payments, instant, relatively low cost, relatively convenient and intuitive. The same revolution really is needed in business to business. There's been a complete lack of innovation in the last 20 or 30 years. And if you think about why that is, well, firstly, there's not a lot of visibility around B2B payments. It seems like it's sewn up by the banks, and it's really not in their interest to innovate. So the banks, in their transaction services business, they're making 80 or 90% of their profits from B2B payments. And you ask, why aren't you innovating? Why aren't you making stuff cheaper and faster and more seamless? And it's obvious because there's a huge profit pool, and they're cannibalizing their own profits. So they don't have an incentive to improve these systems. So regulators step in. I want to talk about 4 crucial pieces of sort of legislation which have really helped drive innovation in the last 3 or 4 years. The first one was Payment Service Directive 2009. It's been implemented across Europe in the last 2, 3, 4 years. It lets, in fact, it's designed to encourage non-bank startups effectively to come in and challenge the incumbents in the payments space. So you're regulated with very, very low capital requirements, quite low reporting requirements, and you can get going with sort of 3 months of regulation, which is actually quite lightweight. It's extremely useful for fostering that innovation. The second is SEPA direct debit. So direct debit in the UK basically enables you to give someone else authority to take money out of your bank account. So you usually pay for your gas bill, your phone bill. You can also use it for B2B invoicing payments. So one of our customers, for example, is a coffee supplier. So they're the guys behind all of these coffee shops. They're sending out different volumes of coffee every week. They're sending out food, and they're invoicing 2 or 3 times a week to each of these cafes. So you set up a direct debit, and then money can be pulled out of your account to meet the invoices, and the data is passed through to reconcile the invoice without someone having to manually do that. SEPA direct debit is effectively that system across Europe. So it's available across the Eurozone, mandatory implementation in the middle of 2014. So that's designed by the European government to reduce barriers to trade, really. So they're making this payment system available at the same cost as local transaction. The third thing is e-invoicing, which in some Scandinavian states and across Europe in some places is mandatory. So instead of sending out a paper invoice, which then gets lost and you resend and have to remind, you send an electronic invoice. And the important piece there, if it ties into payments, the reconciliation is completely seamless. So again, you reduce all of this manual work that's taking dozens and dozens of people in accounting departments all of their time to reconcile. The fourth thing is the phasing out of cheques. So unclear when this will come in, but if you remember that 70 to 80% of B2B payments are cheque-based, this could be a huge, huge revolution. So looking at phasing out sometime towards the end of this decade. So if you put those 4 things together, you get a situation which is dramatically different. And some of our customers do use all 4 of those things. So cross-border, we take advantage of the Payment Service Directive, their cross-border payments with e-invoicing and payment not via cheque but via electronic payment. We've seen reduction of about 80% in terms of resource and time spent in the accounting function. And that's astronomical change. Reduced bad debt for many of our customers by up to about 60%. So the second thing, this is data-driven. What does this mean? So really, it's about fitting in with existing processes. So it's not making people change the way they work. It's using their existing processes but making them more streamlined. So you're happy invoicing. You're happy sort of with accounts payable ticking off ensuring that the payment's valid effectively. But instead of actually having to push money out and manually reconcile, why don't we make that automatic? Why don't we make the invoicing electronic, not paper-based? There's this wonderful phrase called straight-through processing, which is laughable to the internet generation. What straight-through processing means is that you can pay someone or kind of send an invoice and receive the money. Straight-through processing in the context of invoicing means that the data doesn't have to be manually rekeyed. There isn't a human being typing the numbers back in, which to someone who's grown up with the internet is an absolutely laughable statement. Why wasn't it like this from the start? And the reason is, I think, because it was entirely paper-based. So this is a job that computers are really good at, and not human beings. I'd like to talk about the kind of things that this data can enable. I'm sure Errol, in a little bit, will talk about how this could be interesting for lending. So if all of your invoicing and the cash flow is done through an electronic system, you can actually have visibility over a company's cash flow. It makes extending credit to those businesses much, much simpler because you can forecast, actually, are they going to pay back my loan? In the next 2 to 3 months, can we spot distressed creditors? Can we spot bad debt earlier? You can also aggregate purchase orders across corporations, resulting in huge cost savings. You can also, as a business, identify your problem customers and your bad debt earlier. The key challenge, we heard from a friend from PayPal, is a very strong data-backed identity service. That's not something I'm going to talk about, but I think that for the next 5 or 10 years is going to be a crucial part of payments online. So how do you really prove that you are you and that you have authority to push money out from this bank account? It's an absolutely crucial question. So finally, is it disruptive? I'm not quite so sure. It's certainly disruptive to the banks because global transaction service in banks, 80 to 90% of their profits are coming from B2B payments. So sure, it's going to disrupt the banks. But from the point of view of corporations and businesses making payments, actually it's just becoming more seamless. It's not disrupting them at all. It's enabling them to focus on what they do best, whether it's make the best coffee in the world or put up the best buildings or sell the best shoes, give the best customer service. It's not employing the most people in your accounts receivable department to reconcile your invoices. That's not something businesses should be spending time on. I think this really is a case, apologies for the cliche, but of software eating the world. This is software coming in and making accounts departments redundant, quite literally. So the result of this is greater efficiency, which in the short term leads to higher profits for corporates, but in the longer term it leads to lower costs and better service for consumer. So I think Money 2.0 in the B2B world really will be borderless, data-driven, and disruptive. Thank you.
So Tom, I think you epitomised the young upstart, the disruptor. So you went through Y Combinator, which is a most competitive kind of mentor-led incubation stroke accelerator organisation. I think only about 4% of applicants get through. And they've got a fantastic track record. Companies like Dropbox come out of it. So I'm interested in knowing how your initial idea was modified through the whole Y Combinator process.
That's a great question. I don't know the exact numbers. It's something like 40% of people actually, in that 3-month process, change what they're doing. And we absolutely did as well. So we started the idea of helping groups of people collect money, whether the group was a sports team, a university society, something like that. And throughout the 3 or 4 month process, we realized actually groups, they have this problem, but it's half an hour a week problem. Businesses have this problem full time. And they have this problem to the extent that there are dozens and dozens of people in accounts who are trying to deal with it. So, I hate the phrase, but yeah, the pivot towards sort of the business world was what we experienced, I think.
And what surprises have you had on the journey? Now you're a company. What have you not expected? What have you got wrong in your own thinking?
Learning by mistake. Good question. I think I was surprised how much regulation can actually help. I think when you're coming into an area like payments, regulation seems like a really, really big hurdle, and it seems like something very scary. And it seems like lots of hard moving pieces that, why don't we let's start a new social network for cats. That's really easy, there's no regulation. Whereas with payments, there's a lot, and you have to deal with banks and incumbents and regulators, and that's quite tricky. But actually, once you dive into it, it's not that complex. And you can actually see it's quite beneficial. I think that's what surprised me most.
Thank you very much, Tom Blomfield.